Welcome. I am Carol Golden, and I'm the Director of NAIFA's Limited and Extended Care Planning Center. June is Annuity Awareness Month. Easy for me to say, right? And today, Tom Risky of LTCI Partners will be presenting Annuities and Long-Term Care Insurance, 2 case studies in planning. Before we get started, a few housekeeping rules. All attendees are on mute in listen-only mode. If you have a question, please use the Q&A feature at the bottom of your screen. We will address questions as time permits at the end of the session. As a member of the LTC community for many years, it's my pleasure to introduce you to Tom Risky. As the Managing Director of LTCI Partners, Tom leads one of the largest national insurance distributors focused exclusively on long-term care planning. Tom has been working in the long-term care insurance industry since 1991. As a NAIFA member and sponsor of the Limited and Extended Care Planning Center, he and his company are firmly committed to the goals of NAIFA and educating Main Street America about the need to plan for care. You know, annuities are a great way for people to grow their money and guarantee lifetime income. But many people don't realize that annuities can also be used to help plan against the cost of an unplanned long-term care event. In this presentation, we will look at 2 case studies in how annuities can help fund a plan. We'll look at an example of how a PPA, that's the Pension Protection Act annuity, can result in tax-free long-term care benefits, and also how annuities can help fund a combination life and long-term care plan. Ladies and gentlemen, Tom Risky.
Thanks, Carol, and happy Monday, everyone. And it's great to be here during Annuity Awareness Month and also talking about long-term care insurance. As you can see, my contact information is there, so if anybody has any questions after the presentation, they can please feel free to email me. Website too, I do a blog. Our company does a blog on all long-term care related issues and planning topics that you can participate in, and some of those have been shared with the LECP community as we're trying to build it. As Carol mentioned, we're a sponsor, really believe in the mission of what NAIFA is doing related to putting the focus on long-term care planning. And we've never seen a more important reason than during this pandemic, when we've seen the impact of long-term care on our seniors who have been dramatically impacted. And I think that the need to plan is in everybody's best interest at this point. And annuities in long-term care can be a big part of that. And unfortunately, there has not been probably as much emphasis on how they can work together in plan for care than should be, based on what you're going to learn, some of the great benefits available. And I think if NAIFA members and insurance professionals in general can get out there and spread the word, more people will be able to take advantage of this planning. So a couple disclosures first. These are, of course, we're going to talk about a couple different tax issues, but I'm not a tax expert, and that's not the purpose of this. So I just wanted to go through those disclosures really quick. We're going to talk about today, again, annuities and long-term care and overview, and then we're going to look at 2 case studies. Somebody who has an existing non-qualified annuity that's going to benefit from the Pension Protection Act examples. And then we're going to look at also how to fund a lifelong long-term care combination plan with annuities as well. Both of these case studies have been provided by the LECP sponsor, One America. So I really thank them for providing this. But I wanted to say straight out that there's several different insurance carriers that offer combination annuity long-term care plans. And there's many companies that will also offer the same concept of funding a lifelong long-term care plan with annuities as well. So I hope you find these case studies valuable, and let's get right into some of the topics we're going to talk about. I think first and foremost, wanted to get an overview of different ways to fund long-term care. You know, we always say at our company, never confuse having a checkbook with having a plan. And if you look at the far right-hand column, pardon me, self-funded is really somebody's default long-term care insurance plan. If they don't have an insurance policy, they're going to use their own money to pay for long-term care. And I think no matter who, and we always talk about when you're starting a conversation with somebody about the need to plan, don't start in talking about insurance products. Talk about understanding how currently they're going to pay for care and understanding how Medicare and Medicaid work in paying for long-term care and how those programs are funded and how they're taxed and what states do. I think that base level of education is very helpful before you get in and talk about different insurance products that are out there. So if you go to the far left-hand column, we've got your traditional long-term care insurance products, which Carol and I are very familiar with, having worked in the industry for a number of years. And the word we like to get out is that it's still a very robust market with many carriers out there. And the issues in the past that traditional long-term care insurance carriers had with pricing due to some other issues and some of the rate increases, a lot of those issues have been mitigated through newer, more conservatively priced products. So I think a lot of people who want to look at the most insurance protection for their dollar for long-term care should definitely look at long-term care, traditional long-term care insurance. Then we've got the fastest growing area of long-term care insurance, which is the hybrid marketplace or combination marketplace. A lot of different names for these products that combine life and long-term care insurance. The main appeal is the fact that you've got no use it or lose it often and guaranteed premiums for care. So with the life long-term care hybrid products, it's a very competitive marketplace. A lot of different companies are offering plans where prior there were typically only single-based premiums. Now there's a lot of products that offer extended pay premiums, 10-pay, lifetime pay. A lot of creative inflation options are available in the products. And it's really encouraging to see the competition, all the products that are out there and making an impact as well. In the middle column, you have products that accelerate a death benefit. So as opposed to the asset-based hybrids that include an extension of benefits for long-term care, life insurance products with a rider will simply accelerate the death benefit for long-term care insurance needs. Again, very valuable and important protection to have. And it's an important component of long-term care planning. And what we like to say is that we think that there's no one answer for everybody. So there can be a lot of different solutions. In fact, you've seen people who will have maybe a traditional long-term care insurance plan through a job, through an employment, and have a rider on life insurance and add those up, and they provide really substantial, great long-term care insurance benefits. And then finally, we've got the annuity long-term care programs that we're going to go into a couple different case studies for. And if we looked at the pros and cons, typically the underwriting for these products is a little bit easier compared to products that have pure long-term care insurance protection that's going to start off from the first dollar, or a life insurance long-term care product that's going to have a life insurance benefit as well. Because with an annuity product, you're typically using your own money to pay for care first, so there's kind of a big self-funding component to that, which allows the insurance carriers to be a little more liberal on the underwriting side. The other thing we'll obviously talk about is the opportunity to get long-term care insurance benefits out of the annuity tax-free. So that's a real critical importance. It's the only way you can really get that tax-free money out of that annuity. So There's a lot of different ways to fund the long-term care plan, and the annuity option is an important one as well. Let's go to the next slide and give a little bit of overview of the marketplace. According to 2017, there's over $2 trillion of retirement annuities in force. 2017, $95 billion of variable annuity sales, $108 billion of fixed annuity sales, and the average purchase age of non-qualified annuities is 51 years old. So there's a huge market of people who have existing annuities. There should probably be a lot more people who are looking at annuities in general, and that's one of the goals of Awareness Month, to make that happen. But we do have a big existing market as well. And typically, annuities are purchased for the following reasons. Growth, offering tax deferral because of the tax benefits of annuities and life insurance as well. Offering a guaranteed lifetime income. And finally, having additional benefits to guard against catastrophic illness. And that's the focus we're going to put on today's case studies. We're not really putting the focus on the growth or the accumulation. These are protection products that are going to help in case there is a potential long-term care event. As we've seen again during the pandemic, there was an article I saw the other day about the fact that Alzheimer's, it seems people who have Alzheimer's who get coronavirus are more dramatically impacted than you think they would be. So there's so much we don't know about. And I think this is a wake-up call that we need to do more planning. According to a Gallup poll of non-qualified annuity program owners, 83% intend to use their annuity to avoid being a financial burden on their children, and 73% intend to use their annuity as an emergency fund for catastrophic illness or nursing home care. That's a dramatic number of, a huge percentage of people who really look at these as a safe place in case they need the money. So let's look at the concept of an annuity-based long-term care insurance plan. So combining an annuity with a tax-qualified long-term care insurance benefit. And for those on the call, most of you are probably familiar with this, but HIPAA kind of set the tax stage for long-term care insurance back in 1996. And it said that in order to get those benefits tax-free, there had to be certain benefit triggers that policies met. The long-term care event had to be expected to last 90 days, and you had to either not be able to perform 2 of 6 activities of daily living, or have a cognitive impairment that needs substantial supervision. So from a consumer's perspective, if you're looking around at different, and it's called long-term care insurance, the good news is whether it's a traditional policy, a hybrid life long-term care policy, or an annuity LTC, you can understand that the benefit triggers, how you're going to be able to access your money, is going to be fairly similar among the different product categories and carriers. So in this case, we've got someone who has a mix of their retirement savings, some in aggressive investments, probably stocks, more moderate investments, and then a very conservative portion of their investments as well. And of course, as people age, they typically get a little higher percentage of their money into conservative assets. And in this case, what this concept is taking a small slice or a portion of those conservative assets and taking it to a annuity long-term care insurance product. Pardon me. Which will allow the policyholder to access their annuity value for long-term care, tax-free, and if that's exhausted, be able to access a rider that will then go and provide additional protection, in this case, $500,000, $800,000, or even more benefits, depending on the policy someone purchases. Glass of water. So there are, that's kind of the way the concept of annuity-based long-term care insurance works. There's the acceleration of the benefit value and then a rider that will kick in. And the Pension Protection Act makes this all work. So effective 2010, the Pension Protection Act, the PPA, allowed a 1035 exchange, a tax-free exchange, from a annuity, that non-qualified deferred annuity typically, into a annuity long-term care product that are PPA eligible, so that you could then get money out of those tax-free. So of course you've got the cost basis in there and then the gain, but that gain, if you use it for long-term care uses and events, that money will come out tax-free. So that's a huge advantage to a Pension Protection Act. And for a client who has raised their hand and said, you know, I'm really concerned about long-term care costs in the future, offering this type of annuity and exchanging that for an older annuity could make a lot of sense. So we're going to look at a case study on how that works. But before we do that, just want to make sure that people don't mistake other annuity features that may offer, you know, riders that will double the income for confinement or waive for terminal illness or nursing home. Those are a little bit different. You know, the way to really know a true annuity long-term care program is there's going to be some health underwriting involved, because in order to get that additional rider and benefit, there's going to be some underwriting that's going to be shown that the applicant won't start using those right away. Again, the underwriting will be a little easier than what traditional long-term care insurance is, or hybrid policies, but there's still going to be some underwriting involved. If there's no underwriting involved, it's going to be difficult to provide a significant long-term care insurance benefit available. So in this case study, we've got a 81-year-old female who is, you know, wants to protect against long-term care insurance, but because of their age, because of health issues, they don't think that they can either qualify or want to pay for a life-based long-term care insurance plan. However, the good news is they have $125,000 in an existing non-qualified annuity. And they are looking at a product that provides additional long-term care insurance benefits. And they don't want to pay existing ongoing premiums for that. They kind of want a one and done to make that happen. Guarantees are a top priority, and also making sure that the policy will pay for care at home or assisted living or in a nursing home in the worst case situation. And if we look at this particular product they're looking at, again, this is an example from One America, a product called Annuity Care. This product offers an initial benefit that provides a 36-month base of the annuity value initially. So it's a very simple deferred fixed annuity that'll grow the cash value. It'll pay that 36-month payout for long-term care of the value. And then again, those LTC benefits are going to be tax-free. And there's, in this example, no interview for, you can get this product without the underwriting. But if you really want the rider involved, which can be either an additional 36 months of care or for a lifetime, in this example, underwriting will be involved. And the nice thing about a particular rider, there is some flexibility. You can pay for it with a single premium, or you can pay ongoing, a 10 pay, a 20 pay, or a continuous pay. Those premiums are all guaranteed, non-cancelable premiums. You can actually add inflation protection to a product like this. You can, again, do either 36 months or a lifetime. And we're going to look at an example where everything's been funded together with a 1035 exchange. So with that $125,000 for this female who has that existing non-qualified annuity, with a 3% interest rate, they're going to take take that money, and it's going to be kind of split in two. The 102,500 of it is going to go into that base annuity, and 22,500 is going to go into the rider that's going to pay for a lifetime of long-term care coverage. So that $125,000 single premium done through a 1035 tax-free exchange from an existing non-qualified annuity will provide a policy that will provide an initial value of $102,000 plus this lifetime benefit. So what that means is that client, if they need long-term care, will have the ability to access up to $36,000 per year tax-free benefits for their life. And that's kind of what they were looking for. They were looking for that assurance that they wouldn't run out of money. And that's what this product will do in case long-term care is needed. Of course, what are you giving up with this? You're probably not going to have as high an interest rate as your existing annuity. And you're going to reduce, because you're buying the long-term care insurance portion, you're going to reduce your existing cash surrender value currently. However, I think we discussed best interest needs. I think for an 81-year-old who's got other assets as well, this really is in their best interest because they're insuring against the cost of long-term care, against an Alzheimer's event. This really does pass that test of probably being in a client's best interest. To go do this could make a lot of sense. And we talk about they give the example of the type of interest rate that would have to be able to provide a $36,000 on a $125,000 annuity, which is 29%. So that's the example of how powerful these annuity long-term care plans can be. And if you look at the example of how it works with an illustration, you can see that $125,000, again, the accumulated and cash surrender value is going to be reduced, but you now have a long-term care and a monthly benefit available that goes for a lifetime. So this is an example of somebody who, again, 81-year-old, they have a current annuity out of that surrender period. They can do a 1035 exchange and have the ability to get money out of that policy cash-free. And I think that this is a great conversation to have. There's a lot of people probably in this boat who are concerned about long-term care and want to look at this type of option. I mentioned underwriting again, and typically there's no paramed exam, which is really important today in a world where we're trying to limit as much face-to-face contacts. Typically no APS in this case, and usually with the rider, there's a telephone interview. So one of the things that will occur is, I'm sure there's going to be a cognitive screen as part of these policies. So if you've got somebody with cognitive issues, a product with a rider that really extends out probably isn't going to be a fit. But they can still, exchange their annuity for a PPA, Pension Protection Act qualified annuity, and get money out tax-free. That is an alternative, but they're not going to get that additional benefit that'll go on for years or lifetime without giving some demonstration of evidence of insurability. Okay, so that was our first example. Our second example was a little bit different because instead of buying a combination annuity long-term care plan, this is going to be someone who's going to buy a life long-term care insurance program using qualified funds. So Ron and Nancy are been married 35 years, retired Marine, and Nancy being a teacher, great savers. So they have a sizable IRA, high pension income. So they have a lot of qualified income. When it takes time to take their RMDs, they'll have more income than they need. Now they're young, 60 years old. So potentially they could buy traditional long-term care insurance and it might be a fit for them, but they kind of want the guaranteed available on life LTC policies. So that is why they're looking at those combination products. But you know, they don't have a ton of, they're not interested in taking money that's savings outside of their qualified money to buy a single premium life LTC plan. So here's what they're going to do. They're going to purchase an annuity that's going to fund a 10-pay long-term care, life long-term care plan. So this is, again, One America's the product example here, but other companies offer these type of solutions in which they transfer $200,000 from their IRA, and that will allow them to acquire a annuity with a value of $240,000 in this example. And that annuity will then fund a 10-pay long-term care, life long-term care insurance product that will, again, pay for that entire amount. So once they've done this initially, they're gonna have to worry about needing additional premiums in the future. All of that is taken care of. The annual premium is gonna be $24,000 combined, which will incorporate a $240,000 death benefit and long-term care insurance benefit as the acceleration. But more importantly, it'll have a lifetime rider on that long-term care insurance benefit as well. So they've transferred a portion of their qualified money to pay for this plan that will cover both of them for life. So I think it's a real great approach. Of course, with that distribution, that's going to be a taxable event. Something you wouldn't want to do under age 59 and a half, of course, because of the penalties involved. But they're going to have to take that money out regardless. And this is a great way to fund a long-term care insurance program. So here's how it works. That long-term care insurance, life long-term care insurance plan this is funding, that's going to be paid over 10 years, starts out with a $249,000 face amount long-term care insurance plan. If they need LTC, that will be accelerated over 33 months. So that will give an annual long-term care benefit for each person of $86,220 annually, and over $7,000 per month of long-term care benefit. With the average cost of assisted living, you know, running $5,000 to $6,000 per month, that's going to be a real nice benefit that they can use for assisted living, more importantly for home care right now. And included in that is a continuation of benefits rider that will pay that same benefit for a lifetime. So there's a lot of flexibility in how this plan operates. Of course, if they decide to change their mind, they have cash surrender value features that are included and a death benefit as well. Here's another way of looking at how that works. That $7,000 benefit or a combined $14,000 for the entire couple. And you've got a no inflation option with the plan they've selected here, but you could actually, with some products, you can actually include an inflation option as well. Lots of different ways to do it. You just kind of have to look at each specific examples, each case studies to see what's going to work the best. And in this case, this is this provides a real substantial benefit that will, really help out, especially with that lifetime pay options. And this gives a ledger, an example of how those premiums work. And you can see the total long-term care benefit is unlimited and see what the monthly benefit level is. However, if they wanted to, again, do it a little bit differently where they decided to do a smaller premium or a smaller benefit initially and maybe offer some inflation protection, that's an option as well, or have a lower long-term care balance. A lot of different ways to approach it, but the good news is that they're taking that and they've got a plan in place with guaranteed premiums. So I want to summarize a couple of those case studies I was talking about, and then we'll have some time for some Q&A. Again, like I mentioned, health underwriting is always part of the annuity long-term care plans that have that rider to be able to access, you know, a substantial rider or an unlimited rider. There's going to be underwriting involved, but because you've got some self-insurance component involved first, underwriting is typically going to be easier than traditional life or LTC plans, but cognitive impairments are typically not going to be looked at as an option. It's a way to get tax-free long-term care benefits out of an annuity, which is really cool. I mentioned you got to be 59 and a half to use those qualified funds for the case study too. And I guess that if you looked at the initial slide in which there's a lot of different ways to plan for care, there's never a bad time to start these discussions and start planning. And I think with all the different options we've got nowadays, with the topic of, you know, how long-term care, do you have a plan? If you're at a nursing home and you need to get out, can you pay for home care? All these different areas out there, they're difficult conversations to have, but I think this time has helped families get closer together in a lot of ways. And hopefully I think we'll be able to reinvigorate these planning conversations and see more people take advantage of it. And I think annuity long-term care plans are a great option to look at and probably underutilized in the marketplace. So with that, Carol?
Well, first I'd like to thank you, Tom. These are obviously very impactful for people who are facing, one, as you said, COVID-19 was a wake-up call, and I think everybody started to think more clearly that planning is really in order now. And so for those people who enjoyed this presentation that you have done, I want to remind them that if you have not already accessed the LECP center at either NAFA.org under centers or at lecp.nafa.org, then you're really missing some very helpful information from people like Tom. We will be posting this particular session. I am sure that people are going to want to review it. In the meanwhile, I see that we are just about out of time. So one, Tom, I'd like to thank you very much for tackling the case studies for us, and hopefully people can reach out to you and thoroughly review the information with you. And I'd like to thank everyone who has joined us today for this session, and wish everybody would stay safe and stay well. Thank you.
Thanks, Carol.